Pratip Chaudhuri, the former SBI Chairman, now joins in on the show. Thank you so much for taking time out and joining in, Mr. Chaudhuri. The big question that we're digging and, finding out about is exactly the outlook is when it comes to the pricing power. Do you think that we are seeing now a return in pricing power for some of the large banks?
I hope not, because pricing power, if it goes to the banks very strongly, then the banks tend to take most risky assets, because that is where the spreads are the highest. In fact, in case of SBI, why it has withstood the last meltdown so well relative to other public sector banks is that we didn't go for yields, we went for asset quality. So there is a trade-off between the interest rate and the asset quality. If you chase higher returns, you will have to sacrifice asset quality, which I don't think the bank should do. In fact, the bank should endeavor to lower its cost of deposit, particularly CASA. And I think I would still advise SBI to roll back its retrograde step of charging penalties for minimum balances in savings account. Because when we went on a massive spree to add to our savings account, we never put this in front. And even for an ordinary poor person, you suddenly charge 200, 300 rupees from his savings bank account. I think that hurts. So I would think that they should concentrate. They have a very good franchise, they have a very good ATM network, they have got other products, card products, etc. So which could be leveraged for growing the savings portfolio.
Okay, what exactly then, Mr. Chaudhuri, is your outlook when it comes to the corporate credit cycle? Is there still more of working cap funding that we need? Where are you seeing the overall cycle currently?
Working capital is a continuous process, and working capital I think gets cannibalized very quickly, because there are many lenders in the short term. So if the working capital yields or the returns get higher, then the CP market and the customers tend to use the CP market more. I would think that the term loan market, term lending market is more enduring. So we should not be guided by the short term, but we should think of building up a stable portfolio in the long term. And then of course, though it has to follow the capex. So banks should lend only when there is a capex. So it will depend on the capex cycle how it turns.
Since we have you with us, wanted to get your view on interest rates going forward as well, especially in the light of the GDP growth actually moderating. Would you say that besides of having that elbow room, the central bank may go in for a pause next time?
No, I think central bank should go in for a cut, but I think this is all very peripheral, this cutting this repo rate. What would bring down the rate of interest? Because today the real rates of interest in India are very high, and that is what is hurting our manufacturing sector in particular. So in order for the real rates of interest to come down, RBI should let go the CRR or at least lower it. And secondly, the deposit competition is not coming from others, but from high administered rate on postal savings schemes. So I think the postal savings rate need to be moderated in the context of present prevailing deposit rate. Otherwise, the cost of funding for the bank would not go down, and obviously the bank would not be able to transmit the lower cost of lending to these customers. So it will remain in the kind of situation it is now.
So, Mr. Chaudhuri, on the whole, what is the outlook on stressed asset resolution so far for the system, particularly when it comes to stressed sectors like steel and power, telecom even?
No, I think it is, I will not generalize according to sectors. In fact, even in steel you find that there are more takers for the large companies. But to what extent there would be takers for medium and small companies, that would be the real test. But I think banks in the meanwhile would have provided for. And power sector I think is more tricky, because there are issues of coal linkages and there are issues of wagon availability, though on paper things seem to be working very all right, but if you talk to the power producers, they still have issues on wagon availability, coal availability, and of course the price of course would be market determined. So there has been a great dynamism in pricing, with most of the discoms are approaching the spot rate and the IEC rate for power. So power, I think, but the demand doesn't seem to be as robust, because there are a lot of energy saving initiatives that are happening, there are a lot of clean energy capacities that are coming up. So it will remain on this, and I think one has to look to how the resolution for power assets happen.
Right. Do you see rising
and maybe
NPAs?
A large part of that would have to come from hiking in tariffs for the consumer.
Sure. Do you see rising NPAs for banks and NBFCs and real estate sector being a concern?
Of course, it would be a concern, because particularly residential real estate sector, if there are not enough takers and the semi-finished buildings do not get completed, then how will the EMIs be paid? So that, of course, in certain pockets, particularly NCR, not so much in Mumbai maybe or Bangalore, but NCR, that's definitely, because there are a whole lot of semi-finished or partly finished flats that are lying and the house owners are not able to move in. But now I think with the Supreme Court stepping in, let's hope there is greater speed at the resolution, and the promoters who are unsuccessful being kept out of the projects.
Right. And finally, what exactly is your view, and how positive do you believe is the move for SEBI exempting lenders from the open offer in IBC cases?
No, that is very enlightened and timely, because you know the whole IBC process envisages that when the repayment is not coming from the cash flows, then the banks would do a debt equity swap. So the banks would step into the equity in exchange for the full debt or part of the debt. Now in this, if you bring in open offer, then it complicates the matter for banks, and it makes it difficult for them to take call for future exposures. So therefore, clarity on this, that the open offer would not be made available, open offer need not be made available, is very helpful. And I think now let this be the precedent, so that even investors, let us be fair to the equity investors also, let the equity investors also know that in case of a difficulty, it is the banks who will take on the equity, and without having to make an open offer.
All right, going to let you go on that note. You've given us a lot of clarity as to what you make of the sector as a whole, how you're looking at the pricing power, the corporate